In the dynamic world of financial markets, understanding price movements is paramount for successful trading. The financial markets are a complex and ever-changing landscape where prices can fluctuate wildly within seconds. For traders, the ability to interpret these movements accurately can mean the difference between profit and loss. This is why a deep understanding of price action is essential. Price action refers to the movement of a security's price plotted over time. It forms the basis for all technical analysis of a stock, commodity, or other asset chart. Many traders believe that all the information they need to make a trade is contained within the price action itself. Traders rely on various tools and techniques to decipher the language of the markets, and these tools have evolved significantly over time. From simple line charts to complex algorithms, the methods used to analyze market trends are diverse and sophisticated. However, at the core of these techniques lies the fundamental principle of understanding price action. By studying the patterns and formations that prices create on charts, traders can gain insights into market sentiment and potential future movements. This process involves a combination of technical analysis, historical data review, and an understanding of market psychology. Among these tools, candlestick patterns stand out as a powerful visual aid. Originating from Japanese rice merchants in the 18th century, candlestick charts have stood the test of time and remain one of the most popular methods for analyzing price action. Each candlestick on a chart represents a specific time period, such as a minute, an hour, a day, or even a month. The shape and color of the candlestick provide valuable information about the price movement during that period. For instance, a long green candlestick indicates strong buying pressure, while a long red candlestick signifies strong selling pressure. Candlestick charts provide a comprehensive view of price action, revealing the interplay between buyers and sellers over a specific period. This visual representation helps traders to quickly assess the market's current state and make informed decisions. The body of the candlestick shows the opening and closing prices, while the wicks or shadows indicate the highest and lowest prices during the period. By analyzing these elements, traders can identify patterns that suggest potential reversals, continuations, or indecision in the market. This ability to read and interpret candlestick charts is a crucial skill for any trader. Each candlestick tells a story, narrating the battle between bulls and bears and offering valuable clues about potential market direction. The constant tug-of-war between buyers, bulls, and sellers, bears, creates patterns that can be predictive of future price movements. For example, a series of long green candlesticks might indicate a bullish trend, while a series of long red candlesticks could signal a bearish trend. Additionally, certain candlestick formations, such as the hammer, the engulfing pattern, and the shooting star, can provide further insights into market dynamics and potential turning points. Among the many candlestick patterns, the doji holds a unique place, often signaling a moment of indecision or a potential shift in momentum. A doji candlestick forms when the opening and closing prices are virtually equal, resulting in a very small body. This pattern suggests that neither buyers nor sellers have gained control, leading to a standoff. The appearance of a doji can be a precursor to significant market moves, as it indicates a potential change in sentiment. Traders pay close attention to doji patterns, especially when they occur after a strong trend, as they can signal a possible reversal. By mastering the art of interpreting doji candlesticks, traders can gain a significant edge in their trading endeavors, making more informed decisions and navigating the markets with greater confidence. Understanding the context in which a doji appears is crucial. For instance, a doji at the top of an uptrend might indicate that the bullish momentum is waning, while a doji at the bottom of a downtrend could suggest that the bearish pressure is easing. By combining the analysis of doji patterns with other technical indicators and market conditions, traders can develop a more comprehensive trading strategy. This holistic approach allows them to anticipate market movements more accurately and respond effectively to changing conditions. The doji candlestick, with its distinctive appearance, holds a place of significance in candlestick charting. Unlike other candlestick patterns that typically exhibit a clear difference between the opening and closing prices, the doji stands out with its near-equal opening and closing prices. This unique characteristic of the doji signifies a moment of indecision in the market, a point where neither buyers nor sellers have a clear upper hand. The doji's appearance on a price chart suggests a potential shift in momentum, indicating a pause in the prevailing trend or a possible reversal. Traders pay close attention to doji formations as they often precede significant price moves, acting as early warning signals of potential trend changes. The doji candlestick, though seemingly simple in its structure, carries profound implications for traders. To fully grasp its significance, it's crucial to understand its anatomy and the signals it conveys. A doji is characterized by a small body, often resembling a plus sign or a cross, indicating that the opening and closing prices are virtually the same. Extending above and below the body are the shadows, also known as wicks or tails, which represent the price range traded during the given period. The length and position of the shadows provide additional clues about the balance between buying and selling pressure. A long upper shadow suggests buying pressure that was ultimately met with selling, while a long lower shadow indicates selling pressure that was absorbed by buyers. While the basic doji pattern features near equal opening and closing prices, there are several variations of this candlestick pattern, each with its own subtle nuances and implications. These variations arise from the length and position of the shadows relative to the body. The long-legged doji, for instance, has long upper and lower shadows, indicating significant price volatility and indecision during the trading period. The dragonfly is higher, but sellers took control, driving prices back down to the opening price. If you found this information helpful, make sure to subscribe and hit the notification bell for more trading tips and insights. The appearance of a doji candlestick on a price chart is akin to a whisper from the market, hinting at a potential shift in sentiment. While a single doji might not be sufficient to draw definitive conclusions, it serves as a cautionary signal, prompting traders to pay closer attention to subsequent price action. A doji appearing after a prolonged uptrend, for example, could suggest that the bullish momentum is waning and a reversal might be in the cards. Conversely, a doji forming after a downtrend could indicate that selling pressure is subsiding and a potential bottom might be near. It's important to note that the interpretation of doji patterns should always be done in conjunction with other technical indicators and market context. While doji candlesticks can provide valuable insights into potential market reversals, it's crucial to remember that no technical indicator, including doji patterns, is foolproof. Confirmation from other technical tools and market context is essential before making any trading decisions based solely on doji formations. Traders often look for confirming signals from indicators such as moving averages, trend lines, or oscillators to validate the signals provided by doji patterns. For instance, a doji forming near a support or resistance level, accompanied by a bullish or bearish divergence in an oscillator, could strengthen the case for a potential trend reversal. Certain doji patterns, when appearing in specific market contexts, can signal a potential shift towards an uptrend. These bullish doji patterns often occur after a period of consolidation or a downtrend, suggesting that selling pressure is weakening and buyers are gaining strength. One such pattern is the Morningstar Doji, a three-candlestick pattern that starts with a long bearish candle, followed by a doji, and then a long bullish candle. Another bullish doji pattern is the bullish engulfing doji, where a bullish candle completely engulfs the body of a preceding doji, indicating strong buying pressure. Just as there are bullish doji patterns, certain doji formations can also signal a potential shift towards a downtrend. These bearish doji patterns often emerge after a period of upward momentum or an uptrend, suggesting that buying pressure is waning and sellers are gaining control. One such pattern is the Evening Star Doji, a three-candlestick pattern that begins with a long bullish candle, followed by a doji, and then a long bearish candle. Another bearish doji pattern is the bearish engulfing doji, where a bearish candle completely engulfs the body of a preceding doji, indicating strong selling pressure. Doji candlesticks, with their ability to signal potential trend reversals, offer valuable trading opportunities for astute traders. However, it's crucial to approach trading with dojis strategically, combining them with other technical tools and risk management principles. One common trading strategy involves using dojis to identify potential entry and exit points. For instance, a trader might look for a bullish doji pattern forming near a support level after a downtrend, considering a long entry if the subsequent price action confirms the bullish reversal. Conversely, a trader might consider a short entry if a bearish doji pattern forms near a resistance level after an uptrend, with confirmation from subsequent price action. Mastering the art of interpreting doji candlesticks can significantly enhance a trader's decision-making process. By recognizing the subtle signals conveyed by these patterns, traders can gain a deeper understanding of market sentiment and anticipate potential trend changes. However, it's important to remember that doji patterns, like any other technical indicator, should not be used in isolation. Combining doji analysis with other technical tools such as trend lines, support and resistance levels, and momentum indicators can provide a more comprehensive view of the market and increase the accuracy of trading decisions. Developing the ability to quickly and accurately identify doji patterns on price charts requires practice and keen observation. Traders can hone their doji recognition skills by regularly reviewing historical price charts, identifying various doji formations, and analyzing their implications in different market contexts. Moreover, using charting software or platforms that offer candlestick pattern recognition tools can be beneficial in the learning process. These tools can automatically identify and highlight doji patterns on charts, allowing traders to focus on interpreting their significance and developing trading strategies around them. In the ever-evolving landscape of financial markets, candlestick patterns remain a valuable tool for traders seeking to decipher the language of price action. Among these patterns, doji candlesticks, with their unique ability to signal potential trend reversals, hold a special place in a trader's arsenal. By understanding the anatomy, variations, and implications of doji patterns, traders can gain a deeper understanding of market sentiment and make more informed trading decisions. However, it's crucial to remember that doji patterns are most effective when used in conjunction with other technical tools and risk management principles. By mastering the art of interpreting dojis and integrating them into a comprehensive trading strategy, traders can navigate the complexities of the markets with greater confidence and increase their chances of success. For more in-depth trading strategies and resources, visit our website. Unlock the full potential of your trading journey today.